Options are financial instruments that give the holder the right, but not the obligation, to buy or sell an underlying asset at a predetermined price and time. The two types of options are call options, which give the holder the right to buy the underlying asset, and put options, which give the holder the right to sell the underlying asset. Options are often used by investors to hedge against potential losses or to speculate on the price movements of an underlying asset. In this tutorial, we will explore the basic concepts of options, including terminology, pricing, and trading strategies. 1. Option terminology. 1. Strike price, the predetermined price at which the underlying asset can be bought or sold. 2. Expiration date, the date on which the option contract expires. 3. Premium, the price that the holder pays to purchase the option. 4. In the money, ITM, an option is in the money if exercising the option would result in a profit. 5. Out of the money, OTM, an option is out of the money if exercising the option would result in a loss. 6. At the money, ATM, an option is at the money if the strike price is equal to the current market price of the underlying asset. 1. Option pricing. The price of an option is determined by several factors, including the current market price of the underlying asset, the strike price, the expiration date, and the level of volatility in the market. The two primary pricing models for options are the Black-Scholes model and the binomial model. 1. The Black-Scholes model is a mathematical formula used to price options based on several factors, including the current market price of the underlying asset, the strike price, the time until expiration, the risk-free interest rate, and the level of volatility in the market. 2. The binomial model is a more flexible pricing model that can accommodate more complex scenarios, such as options that can be exercised early or American-style options. 1. Option trading strategies. 1. Buying call options. If an investor believes that the price of an underlying asset will increase, they can buy a call option. 1. This gives them the right to buy the underlying asset at a predetermined price, which can be sold at a profit if the price of the underlying asset rises. 2. Buying put options. If an investor believes that the price of an underlying asset will decrease, they can buy a put option. 2. This gives them the right to sell the underlying asset at a predetermined price, which can be sold at a profit if the price of the underlying asset falls. 3. Covered call. A covered call strategy involves selling call options on an underlying asset that the investor already owns. 3. This generates income for the investor while limiting the potential loss if the price of the underlying asset falls. 4. Protective put. A protective put strategy involves buying a put option on an underlying asset that the investor already owns. 4. This protects the investor from potential losses if the price of the underlying asset falls. Conclusion. Options are an important financial instrument that can be used for hedging against potential losses or for speculation on the price movements of an underlying asset. Understanding the basic concepts of options, including terminology, pricing, and trading strategies, can help investors make more informed investment decisions.